In a two-speed economy, Australia's biggest supermarket group is moving at the slower speed. Woolworths reported a slowdown in sales growth for the financial year and the fourth quarter. The supermarket chain is the first of the giant retailers to report, and as expected, the numbers confirm that consumers are much more wary. As Philip Lasker reports, it wasn't the only sign that the economy may be shifting down a gear.
If there were any doubts that retailers are finding it harder to make a buck, the Woolworths result should remove them.
The environment has become a bit more competitive, and consumers are hanging on to their wallets.
And hanging on to their money, as Australia's biggest supermarket operator has found. Sales of more than $51 billion for the year to June were 4.2% higher, but growth is much slower than last year. Fourth quarter same-store food and liquor sales growth was down sharply on 2009. The Dick Smith consumer electronics business was also hit by a fourth quarter slowdown, as was the Big W business, where the slump was more pronounced. Inflation helps retailers, but Woolworths' general food and merchandise businesses experienced price deflation for the first time. And consumers no longer have the benefits of the government's stimulus spending.
There is no doubt that at the moment, post to the end of the financial year, we've got people waiting to see what will be the outcome of the federal election.
Analysts also suspect Woolworths is feeling the heat from a more effective competitor, which reports on Monday.
We would have expected some improvement from Coles. They've refurbished a lot of supermarkets. That is starting to gain some traction with consumers.
Woolworths also found consumers in search of a bargain were moving away from private branded labels to cut-priced branded goods, but it rejected claims that the trend was a structural shift with profound margin implications for the industry. There was other evidence of an economy which is cooling as well. Growth in Westpac's leading economic index slowed for a second month in May, but the bank says it doesn't mean the economy is wilting.
What it's saying is that at the moment growth is still well above trend, so it's suggesting that in the second half of this year that growth will be above our trend growth of 3.25%.
And that suggests the Reserve Bank doesn't need to hold off on putting up interest rates if it's inclined to do so. Westpac argues the weakness shown by retailers like Woolworths is a lagging indicator which will be replaced by other stronger performing sectors.
The business investment lead indicators are still quite strong, so that rebalancing of the growth momentum away from government and the consumer towards business investment and residential housing investment looks to be underway,
provided the upheaval overseas doesn't intervene.